Bloomberg is now on your dashboard. With Apple CarPlay and Android Auto, it gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. It's free with the latest version of the Bloomberg Business app. That's the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Brokers.
Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
Mike Regan, Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube. I believe that's the internet. So you head over to youtube.com, search Bloomberg Radio, and that's where you will find us. Mike, I took a look at the 401k, man. I crushed it this year. I'm pretty good at this.
You were in stocks, I take it.
Yeah.
You were all in?
Throw it all in the index fund.
You didn't move out to cash?
No, I've been doing that for 35 years. I don't even think about it. That's kind of my investment horizon, although that's kind of changing as we go along here. But let's talk to somebody who really thinks about it a little bit more deeply than I do. Gina Martin Adams, Chief Equity Strategist for Bloomberg Intelligence, joins us live here in our Bloomberg Interactive Broker Studio. So, Gina, first of all, explain to me what happened from like October 19th to year-end 2023. Wow, we had some big moves in stocks and bonds.
Yeah, I mean, I think a few things happened. First is we were incredibly oversold. Sentiment was very negative. By the end of October, our market pulse index was sitting at panic territory. And it's been pretty good at signaling some near-term wiggles in the equity market, panic to manic, panic to manic. It was really the story of 2023. We hit another panic button by the end of October. At that same time, in the month of October, we started to see the bond market turn over, and I think that was a really big catalyst for stocks, with the surge in yields that we experienced in the third quarter being really painful for equities. The reversal that emerged in the bond market by late October, early November was pretty profound as a driver of risk tolerance in the equity market. And it was off to the races for all markets as we finally got comfortable with the idea that the end is here for hawkish monetary policy. We're likely to move to a much more dovish stance throughout the course of 2024. And that's what markets started to price in the fourth quarter.
You know, Gina, it was another one of those years where it was the huge mega cap growth stocks, you know, the Magnificent Seven or whatever you want to call them, really driving the bus. And I feel like it's been frustrating for sort of old school value investors to watch this happen year after year. There always seems like there's, a dawn coming for value, and value is going to start outperforming. Is this the year for that, do you think?
You know, I think that value actually really started to get its legs all the way back in 2022. And it's a bit of a misnomer that value was a terrible performer last year. It really was about market cap more than anything. When you market cap adjust the value factor, it was a pretty flat year. It wasn't a great year, but it wasn't a horrible year, as you would assume when you don't market cap adjust the value factor. So I think that's something to consider. Also, really from the October lows, small caps have been on a rip as well. So you like to see small caps performing a little well. Value not necessarily, because large caps have been performing also. But certainly lower volatility stocks have underperformed high vol stocks. High leverage stocks have outperformed low leverage stocks. So we are seeing risk tolerance reemerge. Will it be a year for value is a really tough call right now. I mean, I think when you look at the composition of, the value indices versus the growth indices still have the favor of earnings trends. And with policy, sort of the policy impediment going away, it's really tough to make a call for value to be the big outperformer, with the one exception of maybe financials. Inside the value index, you do have a pretty strong representation from the financials segment. And if the yield curve continues to become more upward sloping, that could benefit financials materially. I don't know how much investors are going to embrace that trade, because everyone's still quite scared of what's on the books of the banks.
Yeah.
But nonetheless, there is an opportunity there. And if you can get some stabilization in the commodities complex, that could enable the value trade as well.
Gina, I want to talk about earnings. I'm looking just at the S&P 500, and on the Bloomberg terminal, it looks like there's 12% kind-ish type of earnings growth forecast for 2024. How do you feel about that number? Should I consider some earnings risks still out there in the market?
I think what's happening with earnings is really interesting, because if you were purely relying on macro factors to forecast earnings, you would have gotten the last year wrong, completely wrong. It really isn't about macro-driven earnings trends. And I think that this sort of dichotomy between what we talk about all the time, which is the sluggish macro economy, and what's happening in the earnings environment creates a ton of confusion. But what's really driving earnings growth right now is margin improvement. It has very little to do with top line growth. It has very little to do with some of the broad economic indicators that we're following, with the one exception of inflation. And inflation has been incredibly consequential to determining the earnings outlook over the course of the last 2 years. Inflation's acceleration in 2022 contributed to massive downdraft in earnings expectations and earnings growth. Inflation's deceleration in 2023 became a big tailwind. As long as inflation continues to decelerate, as long as PPI in particular decelerates faster than CPI, you can count on margin improvement to continue to drive some degree of S&P 500 improvement, irrespective of what's going on in the broader macro and broader volume sales environment.
Gina, Paul was talking earlier about how many rate cuts are actually priced into the short-term interest rate market. No one seems to really believe we'll get 6 rate cuts, as the current pricing suggests. What does that mean for the equity market if there is, start to get some disappointment from the Fed speakers to not expect that much easing?
Yeah, this goes back to something we were talking about a little bit earlier, and that is the yield curve going to continue to upwardly steepen? Because that's where you see the risk emanate or sort of work its way into the equity market. Is if the yield curve doesn't behave as anticipated, then you start to see much more equity market sort of weakness potentially emerge. So the question becomes, how much of that rate cut is priced into the short end versus the long end? What's the term premium we're looking at today, which is a whole nother set of questions that we need to answer. I would say it is a risk going into this year, but it's nothing like the risk of, oh my gosh, the Fed has to tighten 5 times, which we faced at the beginning of 2022. And I think that's a really significant point to be made, is the risk of the Fed not quite doing as much as we hoped is very different than the risk of the Fed really pushing the brakes on the economy, which is a very different environment. So I think in nuance, it means that we could have a lot of wiggles. It could be a choppier market than many are anticipating. It certainly is not a market that looks exactly like the fourth quarter of 2023, which was almost idyllic.
Yeah, not many do, right?
We're not going to have the perfect environment emerge. It's probably a much choppier environment through the next four quarters or so, as we contend with a Fed that is going to be on again, off again, and really much more data dependent perhaps than the market is anticipating.
Get a little technical here. Breadth in the market. It was terrible, arguably, for the first 9 months of 2023, the Magnificent Seven. It seemed to get better there during that year-end rally. We had the Russell, outperform. We had even if you look at the S&P equal weighted, that outperformed the SPX. So it looks like the breadth kind of got better in that fourth quarter. Is it where we want to see it today?
It's a lot better. It might actually be a little overbought
really? Okay.
at this point in time. And so I hate to be the bearer of bad news or anything. But when you get to a point where more than 75% of stocks are trading above their 50-day moving average, where RSIs are surging above 80, which is where we were by the end of December, it usually is a point that triggers some degree of consolidation in the equity market. We're already seeing that at the start of this year. So we got a bit overbought on breadth. I don't want to put too much cold water on it because, of course, we want more participation to ultimately fuel the market's gains. And seeing more participation across the world as well as into lower caps is a very good thing for the equity market's longer-term trend durability. But in the short run, it probably does indicate that we're a little too overbought and we're due for some consolidation.
Gina, it's a time of year where a lot of the old seasonality tropes get trotted out dependably and reliably, as goes January, as goes the rest of the year. Some people just look at the first week and believe that that's a sign of where we're going for the year. Are you a buyer of any of that?
Not hugely. I mean, of course, if you have a great January, you've got 1 month under your belt, and so it means that 1 month out of 12 is positive, and so the math works in your favor a little bit. So if we do have a pretty positive January, generally that indicates that your year is more likely to be positive. I think we have to be a little bit more conscientious about short-term changes and shifts in the broader macro as well as in the earnings landscape, and those tend to dominate a lot more of my thought process. I do think that after the incredible surge we had in the fourth quarter, we're due for consolidation. But broadly, all of the trends are still very supportive of stocks and really have been since late 2022. It won't be a perfect climb higher, but it is worth noting that participation is great. We want to see this. Some improvement in momentum is a positive thing. And none of these things are things that we want to fade over the long run.
What's the status of University of Florida football?
Oh, God. Do we have to go there? I mean, secretly, I was really excited to see Michigan beat Alabama yesterday.
Right.
So this is the depths of my despair as I'm now looking at other teams because my team is no longer in the run. It's been a rough couple of years.
Any optimism down there?
I don't know. I would like to say yes, but it's not looking great.
More optimistic about the market than the Gators, it sounds like.
Yeah, I'll stay with that. That'll work for me.
Gina Martin Adams, Chief Equity Strategist for Bloomberg Intelligence and a proud graduate of the University of Florida.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
We got some delivery data just recently for some of the electric vehicle companies, kind of Tesla, Rivian, all that type of stuff. Let's get the latest here from Steve Mann. He's a global auto market research leader for Bloomberg Intelligence. He's zooming in from our Princeton campus down there in Princeton, New Jersey. Steve, let's start with Tesla here. The numbers kind of in line with expectation, but I know the news headline is Tesla falls behind BYD in quarterly EV sales. You spent many years in Hong Kong leading our Bloomberg Intelligence effort there, so you had firsthand look at the growth and development of the Chinese electric vehicle market. Tell us what's happening with, well, first of all, who is BYD and how do they compete against Tesla?
Well, yeah, that's right, Paul. BYD fourth quarter EV sales came in about 8%. Above Tesla's on a global level. So it's pretty significant. It's the first time ever that BYD beat Tesla. Well, BYD is a Warren Buffett backed electric vehicle manufacturer. They're very vertically integrated. They've launched a slew of cheaper, less expensive models in the China market. So that's probably driven a lot of the sales in the fourth quarter. On the back of weaker macroeconomic conditions. So they've done well. BYD's done well.
And yet, Steve, we don't see any BYD vehicles in the U.S. Correct me if I'm wrong about that, at least passenger vehicles. I wonder why that is. Is it tariffs or trade war issues? Is it just a business decision on their part?
Oh, it's a combination of all that. I think more importantly, BYD just doesn't have the distribution network like the big three and some of the European companies have here in the U.S. So it's really hard for them to establish themselves, to really build the brand in the U.S. So on top of all the stuff you just talked about, their focus is really not in the U.S. though. They are getting into Europe. They're planning to build a plant in Hungary. In 2026, it's a low-cost producing manufacturing country, so they want to kind of break into the European market first, then think about the U.S. So we're talking about the EV sales crown. I think it's going to be flip-flopping between Tesla and BYD in the next year, maybe into 2025, until BYD has a plant in Europe. That's when they move out of their local comfort zone, local market in China, and expand overseas. And that's probably when they're gonna, if BYD continue to do well, that's probably when they're gonna solidify the lead for global EV sales.
Interesting. I'm looking at an interesting article on the Bloomberg Terminal today from Bloomberg News. Electric car models eligible for $7,500 tax credit cut to 13 from almost 24. The new list excludes vehicles that use certain Chinese-made parts. That can't be good for EV sales in the United States.
No, it's interesting because the Inflation Reduction Act was supposed to generate or supposed to increase EV sales in the U.S., but it's kind of counterintuitive. But I think that's only temporary because what the IRA really is trying to do is get U.S. to build a battery supply chain locally here in the U.S. so that battery prices come down, EVs becomes more affordable for the U.S. consumer. So if you look at all the investment that's been made so far on battery plants, a lot of those will actually come online in 2025, 2026. That's going to make U.S. battery production a lot more competitive and probably able to produce batteries below what the Chinese are producing at. So that's right. We think EV sales will probably take a break in the next couple of years until more models come in place with play with cheaper batteries, and hopefully the mindset of the U.S. consumer changes a bit, and they become more warmed up to EVs, and hopefully demand will improve 2025 and beyond.
Steve, I rode over the weekend in a Rivian for the first time. My buddy finally got delivery of a Rivian. I don't know when he ordered it. I think it was like 5 years ago. I got to say, it's an impressive car. I mean, I'm no Matt Miller as far as reviewing automobiles, but I was impressed. But then I read today, Steve, that Rivian stock is really taking a beating today because their deliveries in the fourth quarter missed estimates. Now, I know it's a very expensive vehicle. I wonder if that's part of the problem, or is it execution? Is it still supply chain issues? What's going on with Rivian that they're missing estimates?
Yeah, I think it's down 10% today, and it's more of an operational issue. I think a few weeks ago, there was an announcement that AT&T was going to buy the Rivian trucks, and I think everybody got excited. The stock surged quite a bit. I think that's because people thought the break even is actually sooner than later. Right now, Rivian actually loses on every car that they built. So now that they really didn't really miss. They kind of hit consensus expectation, but I think consensus, the street was expecting a lot higher number, a beat. So the thinking is maybe the break even point is not going to be 2024 or 2025, probably in 2026. So the concern is, how are they going to make it through between now and then?
Yeah, these are $100,000 cars too, right?
Yeah.
No room to cut prices. I guess.
Matt Miller was able to arrange a week-long test for me of the F-150 Lightning, which was an awesome vehicle. And I'm not an EV person. I'm certainly not a truck person. I'm a Wall Street person.
Miller's just trucks. Farming out vehicles.
He is. But the sticker on this thing was $94,000. I was like, holy cow, that's just a serious thing. So, all right, Steve, more Tesla news. Their deliveries were pretty much in line with estimates. Is that a good performance for Tesla here?
Well, they did revise their guidance.
They did revise their guidance.
Yes, I think Elon Musk at the beginning of 2023 was talking about 2 million unit number. They had a bunch of price cuts to drum up demand, and they ended up at 1.8. It's probably going to be a slower growth, like I said earlier, in the next couple of years. We think Tesla maybe can able to do 2.1, especially with, the price cuts the series of price cuts that they made in 2023, and maybe Cybertruck coming online. Hopefully, they can get that going quickly, get that, new battery plant going quickly and hit that 2.1. But there is a risk in terms of earnings. It's a tall order for Tesla. It's a balancing act. They want to continue to pump the Model 3 and Model Y out, get sales up, because that's a cash cow for them. But at the same time, they're going to manage ramping up Cybertruck and the next model that they want to introduce, which is a compact. It's dubbed the Model 2. It's a compact vehicle. So there's a lot of things they're going to manage in 2024, and I think there is some risk to consensus earnings.
All right, Steve Mann, thanks so much for joining us. Steve Mann, he's a global auto market research leader for Bloomberg Intelligence, based now in Princeton, New Jersey, after managing Bloomberg Intelligence in Hong Kong for many years.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Michael Regan, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over there if you like, youtube.com, and search Bloomberg Radio. Mike, if you were a fund manager and you weren't all in on the fourth quarter, there's no way you could perform last year.
You have a hard time writing that letter to investors at the end of last year, I think.
Exactly right. Let's check in with somebody who does do this stuff for a living, Phil Toews. He's the CEO of Toews Asset Management. And Phil, thanks for joining us here in our studio here. I believe the last time we chatted with you, you had over 90% of your assets in cash. Hopefully you weren't that positioned in the fourth quarter.
And thankfully we were not.
Okay.
So we have run a pretty tight trend following algorithm across our different asset classes.
Trend following algorithm.
Yes, yeah,
Okay.
that's some multi-syllabic stuff for you there. But we came back into the markets early in the fourth quarter, and we're there for the rest of the year. I mean, you remember that downturn we had last year? It looked like it was going to turn into something. It didn't, and yeah, thankfully most people, if they were invested at least, had a great fourth quarter.
Yeah, Phil, I was cracking up reading your notes to us earlier today. You say the key insight for the year is to adopt a George Costanza perspective.
Exactly. So I guess there are probably listeners that don't know who George Costanza is, but on Seinfeld, he made such ubiquitously bad decisions. He decided the best way to lead his life was to do the opposite of what his judgment told him.
Right.
And I think if you look back over the last really 4 years now, you just see that markets were inexplicable. Like in 2020 and 2021, pre-vaccine, right? Markets were soaring after a downturn, of course, in 2020, and really almost no one could have predicted that. Then again in 2022, we thought markets were going to do okay, despite the fact that we thought inflation was going to be transitory, yields wouldn't go higher, markets got hit very hard. And how many people were predicting a really great market in 2023? Not many. And in fact, if you look at Forbes' collection of Wall Street strategists, that was one of the first times they were ever negative, thinking they would have a 5% loss in 2023. Of course, that obviously didn't happen. So let's just do the opposite of what our best judgment tells us for 2024.
What are your thoughts here as we start the new year?
Okay, so our approach is different than many. In other words, we don't want to be firmly directional for the year. We don't think that's wise for reasons I just talked about. It's almost impossible to predict the markets. So what we embrace is an approach we call a behavioral portfolio. It's an all seasons approach that does two things. It attempts to allow you to be in core asset classes like stocks and bonds, but do it in a way that addresses contingencies. In my notes that I wrote, I said Gene Fama's a smart guy, but what investors want is not the very best performance. They want to be in the markets but not get blown to pieces. So for equities, take half of your equities, put it into hedged equities so that if markets turn down, you're going to have some potentially bolstering, offsetting appreciation in some things. For fixed income, be adaptive. Like have an unconstrained fund that can be in different parts of the market, T-bills, high yield bonds, investment grade.
When you look at some of the indexes of trend following as a strategy, I look at the CTA ETF as one example, of managed futures ETF,
Yes.
The DB cross asset CT index. They had really great 2022s when the stock market was down and the bond market was down. From these indexes, not such a good 2023. When you would think, the equity market seemed to just go in one direction last year. Is there sort of a bias to being short in trend following, that you do better when you're on the short side when the market's going down?
Well, so I think you have to be careful what you look at. So if you're looking at CTAs, often they're investing in trend following and futures contracts that are not necessarily the stock market.
Yeah.
Right. And so you want to focus on something that's more of a pure hedged equity play. But right. So often hedged equity strategies will trail during a rise market, and I think that's why this combined approach of being hedged equities for half of your equities, just conventional stuff for the other half of your equities. On average, if you would have done that, you still would have probably been up, nicely double digits, maybe a little over 20%, not all the way with the market, but you would have been there for the markets.
So how much cash do you have now, or are you essentially fully invested?
Zero cash. So
Zero
when we went long,
okay.
Now I say that with one caveat. In some of our unconstrained bond strategies, we do have some T-bill exposure presently, but across all of our equity strategies and everything else, we're fully allocated.
So in fixed income, fixed income actually had positive returns in 2023 after a disastrous 2022.
Right.
What do you think here? Am I in fixed income? Do I go take credit risk? How do you guys look at that?
Yeah, so I think the mistake that many people are still making is they're looking at how great T-bills were in 2022 and the first part of 2023 and saying that's our bet. Or we're going to go to CDs or fixed annuities or something like that that'll earn a 5% rate. That's the wrong trade. And the reason it's the wrong trade is if you look at the history of investment grade bonds and high yield bonds during a time when the Fed is easing, there have been historically great returns, ranging up as high as 50% sometimes. So this idea that 5% is the best thing anymore has to vanish. So we look at a couple of scenarios. We look at soft landing, hard landing, no landing, as long as inflation is not resurgent, right? As long as that key measure stays low, I think bonds do pretty decently. And then that one contingency, which I do think you have to address, the possibility that inflation comes higher, that could put bonds underwater again. So you need to be, that's why I say agile and unconstrained with your bond approach.
So when you go heavy into cash, it's more a reflection of what you expect the stock or bond markets to do. It's not that yield you're getting on cash in a money market fund or wherever, or T-bills that is influencing the decision.
Exactly. We're just going defensive. We're not making a prediction. We're just reacting to what's happened to the markets, but we're just going defensive.
So when I looked at the fixed income returns for 2023, I was really surprised to see that the real money was made in high yield, kind of a 13, 14% total return. And that's in the midst of everybody every day talking about a recession where I would think you wouldn't want to take credit risk. Why did high yield do so well last year?
Well, I think it's just a function of a couple of things. One of the main things is that, earlier in 2023, high yield bonds were yielding close to 9%. Right, so if that's your starting place before you have any appreciation, that potentially looks very good. And then the fact that we had this strong fourth quarter and high yield bonds rallied a lot in the fourth quarter. So what you were talking about earlier is a big part of what happened.
And Phil, in true Costanza fashion, it looks like you've invented your own holiday here, the National Investment Risk Day. What's that all about?
Yeah, so someone on my staff created this on my birthday, January the 19th, and it's actually registered with the National Archives. It is a holiday. You can find it.
It's the Festivus for investors?
And we used to have a no acronym policy, but now we've called it Nerd Day, NIRD. But here's the thing, is like we continually watch these investments that are super horrible ideas become very popular and then maybe have trillions of dollars of net worth. And what's so fascinating is that often the biggest financial institutions in the world get on board. And so what we're trying to do each year is look at things that are like that, things that are absolutely crazy. What are the most insane ideas that happened in 2023? We have an esteemed staff like the behavioral economist Dan Crosby, Brian Portnoy, and I think even a Bloomberg columnist is coming on to oversee the webinar. So we're looking forward to that on the 19th of Jan.
In 2024, what are you going to stay? What are you staying away from here? Is there something here? I don't know if it's geopolitical risk that's causing you to shy away from something. What are you staying away from, do you think, at this early stage?
Well, at the moment, it's cash.
Okay.
At the moment, you just stay away from T-bills because I think that's the losing trade. Now, I say that understanding that things can adapt very quickly. I mean, we're seeing clearly we have really strong sentiment and sentiment indicators kind of off the charts coming into the end of the year. So just that alone would say that we could have a downturn here. I don't know how big it could be, but I just think, if you already missed 2023, if you were in cash and you didn't experience what we had in the fourth quarter, but also the rest of the year, that doesn't bode well for what may happen in 2024 if you stay in cash right now.
Yeah. Well, Phil, and quickly, we only have about a minute left, but a lot of people poo-poo crypto and Bitcoin these days, but with an ETF coming up, I got to think crypto could be attractive to a trend follower. Am I wrong?
Well, no. Crypto is attractive to one of those three top categories for the dumbest ideas. So here's the trifecta. You need to have something that has no asset value, something that has no income and no potential for income, and has just appreciated 18 million percent in the last 20 years, right? So if you have all three of those, that's like potential dumbest investment of 2023.
All right, Phil Toews, thanks so much for joining us. Phil Toews, he's the CEO, founder, Toews Asset Management, some really excellent performance numbers. Appreciate getting a few minutes of his time. The S&P 500 off about 0.6%. The Dow absolutely unched on the day. Nothing happening there. The NASDAQ off about 1.4%. The Russell kind of hanging in there in terms of relative performance, down only 0.25%. So a lot of those technicians like to see, again, a broadening out of the market, seeing some of the small cappers do well. We're certainly seeing that today.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Michael Regan and Paul Sweeney, we're live here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube So you can check us out there. Unfortunately, there's no shortage of geopolitical hotspots around the world. And we're fortunate to have someone who can really help us stay on top of it all. That's Mick Mulroy. He's the co-founder of the Lobo Institute. That's just the beginning. He's a former Deputy Assistant Secretary of Defense for the Middle East at the U.S. Department of Defense, former paramilitary operations officer at CIA, and then for many, many years, a U.S. Marine infantry officer. We thank him for all of his service here sincerely. Mick, I don't know where to start. There's so many hotspots around the world. Let's just start in the Middle East. I guess the latest headline is Iran is kind of poking around there. What's your latest assessment on what's happening there in the greater Middle East these days?
Also great to be with you guys and Happy New Year. I think obviously Iran's been poking around all this the entire time. They are the common denominator behind Hamas, Hezbollah, the Houthis, and the militias that keep attacking our positions in Syria and Iraq. But now they are entering the Red Sea with one of their naval vessels, which looks like they want to be somewhat confronting the United States without confronting, and certainly looking like they are. And that's, of course, not going to be helpful when it comes to the U.S. interest in containing this conflict in Gaza and not spreading to a regional war.
Well, Mick, I was going to ask you, what is the chance of that happening? I mean, could this really escalate into the type of thing where the U.S. and Iran are fighting more directly? Is that a threat these days?
So I do think it's a threat. It's something we don't want. I don't think Iran wants, and it's not obviously in any country in the region's interest. I think the biggest threat from that comes from Hezbollah, Lebanese Hezbollah, who is currently in violation of UN resolutions where they are up at the border between Lebanon and Israel. Israel's made several statements. Their senior officials, including their Minister of Defense, that they might need to actually take action to push them off that border. If that happens, this would be expanding substantially. And it's one of the reasons why the U.S. sent so many naval assets to the region, just in case there was a significant second front opened in this conflict, that we would be there potentially to assist or Israel if they need it. I don't think that means that Iran's going to become directly involved in the conflict. I think they're happy to fight to the last proxy force, but generally don't want to put their troops into the mix. But that's something that's to be determined, whether if this expands, that could happen, or whether Israel takes more strikes specifically against Iran if they feel threatened.
Mick, I guess, what's the latest, do you think, we're hearing from the Israelis about kind of where they want to take this here? I know they brought some troops home, but is there any change, do you think, to their strategy here?
So the U.S., of course, has been pushing for this new phase, going from what they're calling high-intensity combat to low-intensity conflict. I would point out that doesn't mean it's not a conflict. There's still going to be combat operations. But I think this withdrawal of 5 brigades is substantial. It was partially because a lot of these are reservists and they need to essentially go back to their full-time occupation. But it does indicate to many that this might be that transition. So we might go from this large-scale combat operations, conventional forces, to a more targeted, precise, intel-driven special operations type of mission there. That said, it's been clear that Israeli senior officers have said that this could last for the entirety of 2024. So that we're far from it being over, but I think the U.S. would like to see this switch into this next phase, which hopefully would also have far fewer civilian casualties and the potential to increase the humanitarian aid going into the Gaza, which is sorely needed.
Mick, if we shift gears a little bit to the situation in Ukraine, it seems to me that the political will in the U.S. to continue to fund the Ukrainian resistance is starting to run low, and potentially this might be the year where we actually stop funding that war. What does Ukraine and really the world look like if that's the case? I mean, is it just a pretty much an instant Russian takeover of Ukraine, or how do you see that playing out?
So I don't think it'd be an instant Russian takeover of Ukraine because of the Ukrainians. They will fight to the end. They've proven that, and I think we should take note of that, because if you remember when this started, a lot of very senior military analysts, including intelligence services, were predicting their fall within weeks. And look where we are now. When it comes to the United States credibility, I think it would be shot, to be frank. This is a partner who is in an existential fight. If we were to pull out now, our credibility when it comes to that, I think, would go down substantially. And it is, I think, the morally right thing to do for a partner that's been invaded by an adversary of ours, but it's also in our own interest. I mean, last month alone, according to multiple reports, the Russians lost 30,000 soldiers. Wow. I mean, think about that. 30,000 soldiers. They have degraded the Russian military capacity below 50% of what it was before this started. That means every dime we've spent has added to our own national security benefit. It would make no sense to me, and I don't do politics, but it makes no sense to me why we would continue that support. It's in our own interest. Every dollar we spend on that assists us when it comes to our own national defense.
Mick, as we get into, I can't remember what year we are of this war. Unfortunately, it's much longer than anyone would like. Is there any expectation that there will be a negotiated settlement here? Admiral Stavridis, former head of NATO, made the comment recently to us that he believed is something like a Korea, peace for land type situation is probably the best outcome.
So that certainly could happen. I think what the Ukrainians need is to really push the capacity of Russia to stay in Crimea, which will push them to the negotiation table. I think right now what the U.S. can do is to really start providing them more offensive weapon systems. We started that. They started their counteroffensive before they had anything near what we would need to do what they have been trying to do, which means more F-16s, which are just getting there, more main battle tanks, and more long-range artillery, which really has been a game changer. If they can start challenging Russia's ability to stay in Crimea, that's when I think President Putin will say, maybe I need to start talking about a negotiated settlement. And then I think it's up to the Ukrainian people what they're willing to potentially give for peace. And that's something that I think we should support. We should also allow them to make that decision and not push that on them.
Mick, as Paul said, there sure are a lot of hotspots around the world these days. So I want to take you over to China a little bit, too. One of the big concerns in recent years was some aggression from China towards Taiwan. We seem to have dodged that bullet, but am I being sort of too optimistic there? Is that still a risk going into 2024 that we see some sort of aggression towards Taiwan?
So I do think it's still a risk, and we should not take that lightly. I think what we're doing in Ukraine actually impacts that. When China looks at the type of partner the United States is to the Ukrainians after Russia essentially invaded them, they're going to look at potentially what we might do with Taiwan if they were to either do a blockade or an actual attempt to invade Taiwan. So that's the first thing. The second thing is that the Chinese military is not ready to do this yet. So it's not that we've dodged a bullet. They just don't have the capacity, I don't think, to even do a blockade that would actually hold up yet. But they're driving that direction. They're significantly improving their Navy. They're significantly improving their overall military capacity, in part so they could do this in the future if they elect to do that. Right now, I think we need to be a good partner to show that we're a good partner, so they have that understanding. And Taiwan obviously needs to take the lessons learned from Ukraine and start looking at how they can make themselves a harder target, because that might be ultimately what makes the Chinese decide it's not worth it.
Hey, Mick, just about 20 seconds left. Where could we see a positive surprise in some of these hotspots around the world this year?
So a positive surprise. If you just said a surprise, that would have been an easy answer. A positive surprise. I would hope that once we get all the weapon systems that we've promised and we support Ukraine, that Ukraine could get to a point where Putin realizes he could be in a phase of catastrophic failure. I think strategically he's already failed, but a catastrophic failure is regarding Ukraine itself. And that would push him to the negotiation table, but it requires all of the partners of Ukraine, our allies, to continue support, and of course, them do their job, which they are, which is fighting tooth and nail to get back every piece of territory that Russia took.
All right, very good. As always, Mick Mulroy, co-founder of the Lobo Institute, giving us the latest on the geopolitical issues out there facing a lot of folks.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.